Remember when $1 million home was considered a luxury? Well, by 2027, that might just be the average price tag for an Aussie house. I've been looking into some recent property data, and the numbers are pretty eye-opening. We're seeing predictions of house prices going up by over 20% in just the next 3 years. By 2027, average house prices could hit 1.1 million, with units around $700,000. Given how expensive property is already, these numbers aren't actually that surprising. But the fact that we're projecting that median house prices in Sydney might reach 2 million is quite a wild thought. Even Perth is expected to cross the $1 million mark. These predictions got me curious, so I spent some time digging into the details. I wanted to understand what's driving these increases and if they're as inevitable as they seem. Let's take a look. So, what's actually pushing these prices to such heights? Is it just the natural market growth, or are there specific factors at play? I know what you're thinking: interest rates and affordability concerns. Yes, those are extenuating factors, but there are actually 3 core factors that are underpinning the projected price growth expectations: housing undersupply, migration, and chronic demand-supply imbalance. Let's start with migration. Population growth patterns and demographics have always impacted housing performance, and the effects of COVID-19 on the population profile are still being felt. Obviously, during the pandemic, border closures and restricted travelling meant that we actually went into negative net overseas migration figures between 2020 and 2021. To make up for that loss, the government increased the immigration numbers quite significantly to balance it all out. So, we had a lot of people come into the country in a much shorter period of time than what we've been previously used to. And more people moving to Australia again means more people needing homes. This, in turn, creates some supply-demand issues, which leads me to factor numbers 2 and 3. There's not enough housing to go around. The government's trying to fix it by aiming to build 1.2 million new homes by 2029. But here's the thing. To reach that goal, we need around 240,000 new homes approved each year. In reality, we're only getting around 15,000 approvals in a year. You don't need to be good at maths to know that the maths is not mathing. And Master Builders Australia expect a shortfall of 110,000 homes by 2029, unless developers can somehow increase the pace of building by 40% in the short term. Part of the issue is that it takes longer to build due to supply disruptions and surging construction costs. Recent interest rate pressures have also limited the borrowing capacities of developers, and with no rate cuts on the horizon, fewer and fewer houses are set to be supplied as demand grows. And with more people wanting to buy homes than there are homes available, prices will go up. Foreign investors will also play a big part, given their increased involvement to cash in on the property boom. Now that we understand what's driving prices up, let's look at how this has played out across different cities. When we look at the long-term trends, it's pretty eye-opening. In the 30 years leading up to 2022, property values went up by at least 300% in capital cities and 200% in regional areas. That's a massive increase in just one generation. Houses in capital cities have done even better, growing by 591% between 1992 and 2024. That's nearly 6 times their original value. But it's not the same story everywhere. Let's break it down a little bit. Houses have consistently outperformed units. This comes down to demand and the scarcity of the land. People seem to prefer having their own patch of dirt. Capital cities generally grow faster than regional areas, but regional areas often have lower entry points for investors. Interestingly, values don't usually double within a decade. So when we see rapid growth like we're seeing now, it's worth paying attention to. Now, let's look at some specific cities. Perth is an interesting case. For 30 years up to July 2022, it had the lowest growth of all capital cities, at 303%. But in the last 12 months, it's been the star performer, growing by 23.6%. On the flip side, Melbourne, which dominated for a long time with 459% growth over 30 years, has only grown by 1.3% in the last year. Here's another interesting fact. Back in 1992, houses in capital cities were only 7% more expensive than units. Now, you're looking at a 48% premium for a house. In Brisbane, the difference is even more stark. Houses have grown 389.6% compared to just 170% for units. In the last year, we've seen a trend towards mid-sized cities. Perth, Adelaide, and Brisbane have all grown by at least 15%. Meanwhile, the bigger cities like Sydney, Melbourne, and Canberra have only averaged around 3.2% growth. Remember, timing is crucial in the property market, but that's a whole other topic. We'll dive into market cycles in another video. Okay, so we've talked about rising prices and market growth, but with all the news about economic pressure and interest rate hikes, you might be thinking everyone must be struggling to get their home, right? Well, not exactly. Let's talk about something called distressed listings. These are properties that need to be sold quickly, often due to financial pressure. You'll see them advertised with phrases like price to sell, urgent sale, or price reduced. They're usually a good indicator of how stable the property market is. Now, here's where it gets interesting. Despite high interest rates and the rising cost of living, data from Domain shows that distressed property listings have actually gone down in Australia across all the cities. Yep, you heard that right. Down, not up. That's pretty surprising considering we all talk about how unaffordable it is. A lot of experts were predicting a housing crisis and potential recession due to Reserve's Bank aggressive interest rate hikes. You'd think with mortgage repayments getting higher and higher, we'd see more people urgently trying to sell. But that's just not happening. What this tells us is that the homeowners are choosing to tough it out. They're willing to deal with the financial strain to hold on to their properties. It seems no one wants to miss out on these rising house prices. This is actually because banks are playing their part in this too. The drop in distressed sales suggests they're working with homeowners to help them keep their properties. This is despite the fact that the value of loans more than 90 days behind on repayments has gone up by as much as 39% for some lenders. It's not all rosy everywhere though. While the national average for distressed listings has dropped by 4% since last June, there are some areas that are defying the trend. In the ACT, for example, these listings have shot up by over 88%. That's a pretty significant increase. It's also worth mentioning that this might not last forever. If interest rates stay high and living costs keep going up, banks might change their approach. So what does all this mean? Well, it suggests that despite the tough economic conditions, the property market is more stable than many expected. People are holding on to their homes, betting that the property values will keep rising. Which leads me to the last thing I want to talk about. Are there still any affordable properties left for investors? First off, yep, it's getting harder to enter the property market. Prices are going up pretty much everywhere, but property still has huge potential for financial freedom. Just look at the numbers. In the 2024 financial year, the average Aussie homeowner gained $59,000 just from their property value going up. That's without even lifting a finger. In Perth, it's even more dramatic. If you owned a $750,000 home there, you would have seen a gain of $177,000 in just the last 12 months. Perth's actually an interesting case. The median house price there is now over $770,000. That might sound high, but there are still opportunities. If you know where to look, you can find houses and townhouses selling for under $500,000. And with houses growing at 18.9% and units at 7.2% over the last year, even these cheaper properties could make great investments. Let's talk about townhouses for a second. They're kind of in the middle ground between units and houses. Historically, units haven't grown in value as much as houses, but townhouses tend to grow more than units, but are usually cheaper than houses. It's like getting the best of both worlds. This is really important when you consider affordability. Right now, the average homeowner needs to put over 30% of their income towards their mortgage. For lower income earners, it should be as high as 54.3%. That's a huge chunk of money. Townhouses could be a way for these folks to get into the property market without breaking the bank. There's one more thing to consider: green housing. A lot of people don't talk about this, but since October last year, new homes have needed to meet high energy efficiency standards. We're talking about things like rooftop solar, better installation, double glazed windows, and more reflective roofs. Now, these features do cost more upfront, but they can reduce emissions by 25% compared to older homes, and they can boost property value by 5 to 10%. So, if you're looking to invest, properties with these green features could be a smart move. More and more Aussies are looking for energy efficient homes, so these properties could see even better growth in the future. So what's the bottom line? Yes, it's getting harder to find affordable properties, but they're still out there if you know where to look. And with the right strategy, maybe looking at townhouses or energy efficient properties, there are still opportunities to get into the market and see some solid growth. With that said, while residential property is booming, there's a whole other side to real estate that could offer even bigger opportunities, especially in this market. If you want to learn about a potentially lucrative investment avenue that many overlook, check out this video. Trust me, after what we've discussed today, you'll want to see how commercial property fits into the bigger picture. Anyway, I'll see you in the next video, guys. Cheers.